Welcome to another episode of the Doctors Building Wealth podcast. Today, Kenji and I are going to spend a little bit of time answering a question that we oftentimes get in our courses and online in our communities. And this is a really important question. And the question is, with higher interest rates, it's harder to find deals that cash flow. Should I accept a lower cash on cash return if that's the case? So why don't you start us off, Kenji?
Yeah, this is a great question. Well, before we get started, I think we need to define what cash on cash return is. So cash on cash return is for the amount of money that you put into the deal, what is the return you're getting?
And what we use as real estate investors is we have something called a cash on cash calculator. And in the show notes, we'll actually put a link to our short-term rental cash on cash calculator and our long-term rental cash on cash calculator. If you don't have that yet, you can be able to download both of those and look at all the factors that feed into a cash on cash calculator. So you have a reference point. But basically, as real estate investors, we use this cash on cash calculator. And what it allows us to do is put in all the variables that will have a cost and also be able to put in rents or other sources of income into the cash on cash calculator. And it spits out basically how much cash flow we're going to make from a property each year. And cash flow is, after all expenses, how much profit will we be making from that property. And also the cash on cash return, which represents how much money we will make on the money we put into the property. And that includes things like putting in your down payment and also any rehab, for example, that you do on the property.
And I wanted to further elaborate, you have revenue and expenses. And so revenue is from your rents. Expenses are things that you spend on the property, things like insurance, property taxes, you might pay for property management. And so if revenue exceeds expenses, then you're going to have cash flow.
And so what people often find is when you put all the numbers into the cash on cash calculator and an interest rate goes up and every other variable stays the same, what that means is your cash on cash return goes down and your cash flow goes down. And so people find that it's harder to get returns or get the cash on cash calculations that they want in a market when interest rates are higher and nothing else has changed. So what they often ask us is, hey, instead of aiming for maybe 10% or 20% cash on cash return, can I accept less? Should I accept less? Should I take maybe something that's maybe neutral cash on cash return or maybe 5% cash on cash return? Is that acceptable? And so what would you say to that, Kenji?
Yeah, so the way we approach this is we don't change our criteria. We actually stick to the same criteria. And for us, what we do is if the interest rates are higher, that means something else has to come down in terms of the expenses, or you need to have more revenue to counteract that higher interest rate. Again, the higher interest rate means that you have higher borrowing costs, you have more expenses, so you need a higher revenue to offset that. Or again, as I mentioned, you need to have some other expense category go down in order to counteract that higher expense.
So as a real estate investor, what you're looking at is you're looking at your cash on cash calculator and you're going line by line and you're saying, hey, can I reduce this expense or can I increase this revenue? How can I do that in order to make this still work in terms of your cash on cash return that I'm aiming for? So again, we don't change our cash on cash return criteria when interest rates go up. We just have to lower other areas or increase the rents in order to be able to make the cash on cash return that we want. So why is it, Kenji, that we're not willing to accept a lower criteria when interest rates are higher?
Yeah. So when we're buying, we want to make sure that we have enough cushion or margin. That's the cash flow. We want to make sure that we are able to account for unexpected vacancies, unexpected expenses. That's what the cash flow is there for. It's to protect your investment. It's to make sure that you don't have to reach into your pocket and pay for the property, something that I experienced in the last downturn when I had properties that didn't cash flow enough or didn't cash flow at all, right? Didn't even have revenue. And so what happened in those situations was I had to actually work extra shifts in order to support my properties. That's not a situation you want to be in.
And also the cash flow is actually what you can live on, right? It's what you can use to replace your clinical income or your day job income over time. And so it's not just a buffer, it's actually what you can do. Like when we first started, what we were setting was a cash flow goal. How much cash flow did we need a year to be able to live a life we love and not have to work and trade our time for money anymore? And so that cash flow is really, really important part. And if you're buying something that's neutral cash flow or negative cash flow, like Kenji mentioned, you're really paying out to support it. And it's not going to produce the cash flow that's ultimately going to set you free.
Yeah, it's a good point. It's important to note that the cash flow really serves two major purposes. The first one is that as long as things are going well with the property, there's no unexpected expenses or unexpected vacancy, then it serves as income. And that income as you mentioned, you could live on, you could set aside for a rainy day, you could reinvest, right? That's something that we did was we took all that cash flow, we reinvested it, and that helped us grow our portfolio even faster. And then the other thing, as I mentioned, is that it also helps you mitigate risk, which is also a really important part of investing. Is what you want to do is you want to make sure that whenever you're investing, because all investments carry risk, you want to make sure that you figure out ways to mitigate any risk that might happen. And again, if you're an investor, you should understand that all investments have risk, and a good investor knows how to mitigate that risk.
Now, we're telling you what we do. Obviously, we don't give financial advice, so you have to decide your own path. But for us, cash flow is so important that we're just not willing to buy a property with low cash and cash return or negative cash and cash return that's not going to be able to create a significant enough income to be able to make a difference in our lives, of course, across our portfolio. Now, one other thing to quickly note is when we buy something, let's say it has 10% cash and cash return, we're always aiming to increase that. So we're asking ourselves, how do we increase income? How do we decrease expenses? How can we make this property perform better over time? And we're looking to increase our cash and cash return. So wherever we start today may not be where we are 5 years from now with that same property. And that's the goal.
So naturally, one of the questions that you guys might be thinking is, if we're going to maintain the same cash on cash return with higher interest rates, how do you get that same cash on cash return?
So one of the variables that you can alter most in the cash and cash calculator is your purchase price for the property. You can do that through negotiations. You can do that through acting quickly. There's all kinds of ways that you really can lower the purchase price of the property, but that's really one of the number one variables that you should be able to change when the interest rates are high.
And ultimately, as sellers in a higher interest rate environment, one of the things that you're going to be pressured to do is you're going to be pressured to lower your price, because if you're selling a property to investors, investors are buying for income. And if there's higher interest rates, less income, then naturally there's going to be a lot of pressure for sellers to lower their price. Now, that hasn't really happened that much in this market. I think there's increasing pressure on sellers to lower their prices. And so we are seeing sellers starting to decrease their prices. But again, in a higher interest rate environment, what naturally happens with investment properties is prices do come down. And so if a seller has a great property out there for too high a price, then what you want to do is you want to get it under contract and you want to negotiate to have them bring that price down.
Another way is to look at the rents and see how you can increase rents. And so this is a really common thing that we do in our community is we look for something called hidden value, which is how do we increase the property's value by increasing rents and seeing things that maybe other investors have missed, like maybe there's space for an extra bedroom that will bump rents, or maybe we can put in washer dryers and bump rents, or other things that we can do to really change what the ability of that property has for bringing in more income over time.
Yeah. And then there are a lot of other creative ways that we haven't even talked about, we're not going to cover in this episode. But I did want to kind of throw out one, which is in a higher interest rate environment, why not find ways to lower your interest rate, right? And so one way to do that is you could actually negotiate for the seller to buy points. What happens when they buy points is that it actually buys down your rate. So you can actually potentially buy the property at a lower interest rate. Another one is something that we're looking at right now is that there are certain programs out there. There's one property that we're looking at that is under a HUD, so Housing and Urban Development. HUD is offering a 0% loan for this property that we're looking at buying. And this 0% loan is for a certain amount. And what they do in exchange is that they want you to offer a certain percentage of your units for lower income individuals. And so what you're doing is you're providing low income housing. In exchange, you get this 0% interest rate loan. And when you combine that with the regular loan, the blended rate is actually significantly lower as a result. So that's another really creative way to bring down the interest rate in a higher interest rate environment. And there are so many other ways other than that. We talked about seller financing. We talked about these types of programs that have very, very low interest rates or 0% interest rates. But again, I wanted to mention that there are other ways to be creative when going out there and trying to lower interest rates.
Okay. So that's just a brief answer to the question of, when interest rates are higher and it may be more difficult to find deals that cash flow well, whether or not you should accept a lower cash and cash return. And for us, the answer is clearly a no. And there's other things that we're going to do in the cash and cash calculator to make the numbers work. And that's really where we're going to put our effort when we're seeing that interest rates are higher. Now, if you enjoyed